Joining us is Katie Stockton, Fairlead Strategies founder and managing partner, and a CNBC contributor. Katie, have the nascent rally that we talked about last time, since the beginning of the year, has kind of held on to its gains and actually added to them, and I'm talking about the S&P as well as Bitcoin. Is anything at this point getting done enough work in terms of building solid underpinnings to make this lasting, or are you still think that the support levels that you constantly talk about, those are still in play, much lower?
You know, we did see in January a lot of breakouts from a bottom-up perspective, and that's something that we like to see. It usually shows some improved market breadth or participation. However, since then, we have seen enough of a pullback or sort of retracement in that breadth that again kind of brings us back to the mega cap stocks and how important they are to this tape. We've seen very massive outperformance from the NASDAQ 100 versus the S&P 500. And now that outperformance seems to be fleeting, and we think we'll see a retracement there in relative terms. And that's going to be the real test to the market. We've been talking a lot about sentiment lately in-house, and sentiment has now gotten what we call sort of extremely greedy. You can see it maybe yesterday in Bitcoin. That greedy sentiment makes for a fragile tape. So as much as we've seen some breakouts, some incremental improvement on the charts, I would say it's more short to intermediate term in nature. The short-term breakouts have probably already run their course, and it's not yet impacting the longer-term gauges. So that does tell us that the support levels are still very much realistic. I think 3,200 probably made less likely by what we saw in January, but that 3,500 level, which was tested successfully in October, to us is still a relevant level. The initial support for the S&P 500 is around 3,900, but it's not a major support level. That's a minor support level based on our cloud model. And there's an overhang of resistance based on the same model on a longer term basis. And that's of roughly 42.28. So in order to reverse the downtrend, technically speaking, per that model, we'd actually need to see a couple of solid weekly closes above that 42.28 level.
Well, it does sound like you've moved up the lower end of your range. And I was wondering whether you raise support levels once they become less likely that they'll be tested. And it just sounds like you're describing something with perhaps higher highs and higher lows, but still a trading range.
That's right. So the January's price action did increase the likelihood of a higher low. But I would say a higher low, but that's closer perhaps to the October low than 3,900. The nature of the 3,900 support level, if you think about something like the 50-day moving average, which of course rises over time, you follow that as a gauge of the intermediate trend and sort of support going forward. So that's why support levels rise, and so we revise them accordingly. And yet there are variations in terms of how strong they appear to be.